Global markets just threw a Thanksgiving party, weeks early. And the craziest part, it wasn't gravy on the menu. It was rate cut fever. From New York to Tokyo, stocks exploded in a single worldwide rally. But hold on. Was this pure optimism, or the setup for the biggest plot twist of the year? Stay tuned. The explainer video starts now. And if you want deeper weekly insights with zero hype and maximum clarity, watch our weekly market podcast, available in 5 languages, now playing right here on the channel. Let's go.
Wow. It looks like the entire financial world decided to have its Thanksgiving feast a little early this year. I mean, from New York all the way to Tokyo, markets were absolutely on fire. But the real question is, what exactly was on the menu that made investors so hungry for stocks? Let's break it down. And if you want to boil all that optimism down to just one number, this is it. A whopping 5.52% jump for the Russell 2000 in just 1 week. So why should you care about this index of smaller U.S. companies? Well, it's a huge deal, actually, because when these businesses are thriving, it's not just the mega corporations winning. It's a real sign that confidence is spreading through the very foundations of the economy. So yeah, that really is the big question, isn't it? What was the good news that had investors all over the world hitting the buy button like there was no tomorrow? What was the secret ingredient in this global Thanksgiving rally? Well, the answer starts right here in the U.S., and it's all about the one institution that everyone, and I mean everyone, has been watching like a hawk all year long, the Federal Reserve. And this week, it looks like they finally gave the markets the little hint they've been so desperately waiting for. And what the market was desperate to hear was something called dovish signals. Now, I know, it sounds super technical, but just think of it like this. For the past year, the Fed has been slamming on the economic brakes with rate hikes to fight inflation. A dovish signal is basically the Fed whispering, hey, we might be ready to ease our foot off that brake, and maybe, just maybe, even tap the gas again. And wow, that little whisper was all it took. This wasn't some small niche rally. No, this was a full-on tidal wave. You look across the board, from the small caps in the Russell 2000 to the tech giants in the NASDAQ and the blue chips in the Dow, everything was green. That optimism was just infectious. But here's where things get, well, kind of weird, and this is what's so fascinating about how markets think. The rally was actually fueled by what looks like bad economic news. You see, things like softening retail sales, those are signs the economy is cooling down. For the market, that's fantastic news because it makes a rate cut more likely. Meanwhile, a strong job market, which is great news for the actual economy, is kind of ignored. It's this strange counterintuitive dance that's defining everything right now. So what's the takeaway here? The bottom line is this. Investors are basically plugging their ears to the good economic news and are laser-focused on anything that points to a slowdown. They are all in on the story that a rate cut is coming soon, and that belief is sending the most hopeful parts of the market, like smaller companies and AI stocks, into absolute overdrive. Okay, but this party wasn't just happening in America. Oh no. That wave of optimism went global, crashing on shores all around the world. So let's take a quick trip across the pond to Europe and then swing over to Asia to see how everyone else reacted. Over in Europe, investors got a big dose of their own good news. You had major players, France, Spain, Italy, all showing that price increases were cooling down. And that was pretty much the perfect excuse for the European Central Bank to say, yep, we're hitting pause on rate hikes too, which just added more fuel to that global fire. It wasn't all smooth sailing, though. You look over at the UK, and there's this massive new tax hike looming on the horizon. And yeah, taming inflation is great, but there are real worries that this could just, choke off any future growth. It's a reminder that Europe's path to recovery is definitely still a bit of a minefield. All right, now let's jump over to Japan, because the story here is, well, it's basically the complete opposite of everyone else. I mean, while the rest of the world is praying for rate cuts, Japan might be about to do the unthinkable and, get this, actually raise them. And you don't have to look far for the proof. Just check out the bond market. That number, that's the yield on a 10-year Japanese government bond, and it is soaring to a 17-year high. So what does that mean in plain English? It means the big money is betting that the Bank of Japan, after literal decades of near-zero rates, is finally going to make a move. The big question is, why now? Well, honestly, they've got every reason to believe a change is coming. The data coming out of Japan is just surprisingly strong. You've got inflation that's sticking around in Tokyo, people are out there spending money, and factories are busy.
These are not signals that an economy needs low rates. This could be the end of Japan's long era of lowflation.
Okay, one last stop on our world tour, China. And this might be the most confusing one of them all. Seriously, because what the stock market is celebrating seems to have absolutely nothing to do with what's actually happening on the ground. I mean, just look at this disconnect. On one side, you have the big tech stocks. They rallied more than 2.5%, all caught up in that global AI excitement. But then you look at the companies that actually, make stuff, and their profits are down more than 5%. It's like they're living in two completely different economies. So what gives? Why the huge gap? Well, it looks like investors in China are playing the long game. They're basically looking right past the weak data for now. They're making a bet on two big things. One, that Beijing will eventually step in with more stimulus. And two, that the massive potential of AI will eventually overcome any short-term problems. So to sum it up, we've just seen this massive global party, right? All fueled by the hope of cheaper money. But you know what they say? Every party has a morning after. And the week coming up is just jam-packed with economic data that could either keep the music playing or bring it to a screeching halt. Because you got to remember, all this optimism, it's really just a story the market is telling itself right now. And like any good story, this one could have a major plot twist just around the corner. So let's break down the 5 biggest risks that could completely flip the script. First up, the US. What if that inflation data comes in way hotter than expected? That whole rate cut dream? Poof, gone. Then there's Europe. A similar inflation surprise there could put the ECB in a really tough spot. Number 3, China. If their factory data comes in weak again, that tech rally could disappear in a flash. Fourth, Japan. Any kind of sudden move from the Bank of Japan could send shockwaves through the entire global system. And finally, we circle back to the US to look at the consumer. Is the American shopper finally running out of steam? And really, it all comes down to this. Right now, the market is pricing in absolute perfection. It's betting that central banks can pull off this incredible soft landing, taming inflation without actually wrecking the economy. The big question is the wave of data we're about to see going to play along with that fairy tale ending? I guess we're all about to find out.
If you found this breakdown useful, hit like and share it. It helps more people discover MacroNav. And if you want more clear, no-nonsense explainers on global macro and finance, make sure you're subscribed. Stay ahead, stay informed.